world are you going to tell anything out of this? I mean, this is that same large cluster of volume that I just pointed out. I mean, you can't see the same thing there. So you really need to keep that into perspective there. So with that being said, these are some chart period examples that I feel tend to work well with these two specific markets I have listed here. So with crude oil, I feel the 16 range is excellent in viewing everything correctly. The reason for 16 range is simply that's double what I would look at on a regular price bar chart. So I would look at an 8 range chart on a regular chart. And then the 1500 tick, really all that is 3 times the 500 tick that I've used in the past as well. I've used 1600 as well, but I'm just using round numbers here, so you're not going to see a big difference between 100 ticks, so I just used a round number there. And then the 5-minute chart, that'll work. I will warn you though, during periods of low activity and the market's just going sideways, you'll get this kind of price action on the 5-minute as well. So I wouldn't say it's the optimal setting for this particular tool, but you can certainly use it. And then with the ES, or the E-mini S&P 500 contract, the 8 range is, again, it's double what I would look at on a regular chart. So I would look at a 4 range, and then I want to see double of that, which would be the 8 range. And then the 6 tick reversal, I just showed you that. And then 5-minute, like I just said, it'll work, but there are other settings I feel are more optimal. But my preferences between all of these is the 8 range for the ES and the 16 for the crude oil contract. I mean, you have to work with it yourself and find out what makes the most sense for you. I mean, obviously you just need to find a sweet spot. Too small of a setting, it's just going to create too much noise. And then if you use too large of a setting, you're not going to see enough detail. So it's, like I said, you need to find that sweet spot. But generally, just look to double your standard intraday chart settings. I mean, provided that you are using something that isn't too myopic. And then here's just some of the complementary indicators I feel pair well with the volume at price tool. So the ask bid difference bars, all that really is just the delta bars. And what it provides you is just a visual representation of what the delta is doing between each price bar. So for example, in this particular bar, we opened the bar opened up with possibly some selling and maybe some absorption there, and more buyers stepped in and pushed the market higher. Here there's probably more positive delta. However, there's maybe some profit taking or whatever that was occurring, and then the market had more sellers than there were buyers, and it was just kind of mixed tape, and then buyers started coming back in, and we see positive delta again. So all we're doing here is just giving you a visual aid to what you're looking at on your volume at price chart. This next piece is simply the calculated values that are occurring within each price bar, and this is just simply the statistics of each bar. So you've got the delta at the top, and then we've got the cumulative delta on the day, and then we've got the total volume that prints within each bar. So obviously this is crude oil, the lower volume numbers there, but the idea is, again, to give you some confirmation of what you're seeing on both the volume at price tool as well as the visual representation on the delta bars. So there's obviously more you can add to this, but you really need to figure out what makes the most sense for you, because you can really overdo it. And are you really going to read all these lines? I mean, I would recommend keeping it pretty basic, at least at first, and maybe down the road, if you start to become more comfortable with all of it, you can possibly add more, but I would just stick with the basics. Otherwise, you're just going to inundate yourself with too much information. And as you know, you can't pause the market. So you really need to be able to see these things in quick time there. Another indicator obviously would be the volume profile. I mean, all platforms that I've mentioned in this presentation offer a variation of it. And this is a conversation for another topic, but because we're looking at volume so closely, obviously a volume profile is going to help you with identifying those areas of high volume and low volume. And then, of course, other indicators that work with the volume at price tool would be, VWAP, initial balance, the developing value of the day, any moving averages that you may use. I mean, really, you just want to look to mirror your other standard intraday charts that you're looking at. Just try and mirror them and have the same indicators on them. Okay, so that concludes our first section. We learned what the different variations of the indicator are. We learned which platforms offer it, which data feeds work the best with it, as well as how to view the chart settings most efficiently, with being able to view the volume and everything from a nice clear perspective without having too much noise being created with smaller price bars. So in this second section, we're going to take a more in-depth perspective of how to view and use this indicator in more detail. So reading and understanding the volume at price indicator, this indicator is intimidating at first glance, and it's fairly difficult to understand what you're seeing, and more importantly, understanding the value of the information that's occurring within each price bar. But it provides a clarity like no other chart, and in that you're able to see, like I said, the volume printing on each price level between the bid and ask, or however you decide to plot your chart, and you can see the supply and demand of the market in real time. There are, however, some unique visual nuances that this indicator provides that can provide you with a lot of useful edge. I guess it would be a useful edge is probably the best way to describe that, and I'll discuss those in detail here. So what we're looking at here is just your basic price bar. We've got an open and a close, just like any other price bar chart would, our high and low. And what we're seeing here is the volume printing on the bid and the volume printing on the ask, and this is the highest volume level of this particular bar. The higher volume is being shaded on each side of the market, and you can see how it was just kind of a mixed tape here, and then buyers were able to lift the offer higher. So when we're looking at this indicator, obviously we need to really understand order types and how they appear in the market, how they appear on the tape, and even how it looks on your depth of market price ladder if you use one. So this is obviously basics, but you'd be surprised how many people do not understand how these particular markets appear in the time and sales, for one, as well as more importantly to this presentation, the volume at price tool. So with that being said, let's discuss this in more detail. So first we have is limit orders. Limit orders, everybody probably uses a limit order to get in and out of the market for the most part. This is really just passive activity. It's not showing that the market participant is taking initiative to get into the market. They're really just kind of just waiting and seeing if the market will come to their specific price level and fill their order. market orders alternatively are a sign of aggressive behavior in the market. Um, when you enter a market order into the market, that will print at the current trading price. It's not going to print at the price that the market's or you're looking to try and get in at. So, for example, let's say the market. Well, actually, I'll provide a clear example coming forward here. And then stop limit orders and stop market orders, essentially the same thing. And then synthetic orders. This would include iceberg orders, TWAP, and VWAP orders. And the significance of these is that they represent the large players in the marketplace. So as I mentioned, limit orders are a form of passive activity within the market. The traders that are entering limit orders are simply waiting for the market to trade at their specified level. So in this case, we've got this is just a snapshot of a depth of market price ladder here, or a DOM. And the market is currently trading at 88.94. The bid is at that level, and the ask is at 88.95. So on a limit order, if you wanted to enter in at 88.94, you'll most likely be able to get filled there, provided there's inventory to meet that offer, or excuse me, that bid. So that's just passive activity. And in this example, the market opened at this particular level, traded down, and then traded higher. So you can see as the market traded lower, there were more buyers that were sitting with resting buy orders that outnumbered the number of sellers that were coming into the market, and these were being met with sell market orders, which I'll explain in a minute. So this depth of market you're seeing here is all just resting limit orders. And alternatively, we have market orders. As I mentioned, these are aggressive orders. Again, here's our depth of market price ladder, and the market's currently trading at 66 3/4 with an offer up at 67 even. And let's say that you want to sell this market. Where do you think your order is going to fill? Is it going to fill at the offer, or is it going to fill at the bid? Well, the market is currently trading at this 66 3/4. Unless the bid lifts higher, your sell market order will fill at the 66 3/4 level. And the market orders obviously don't appear in the depth of market. It's an instantaneous order that comes into the market and fills at the current price. And what that is like I said, it's a sign of aggressive activity. So in this example here, we have orders that are being filled probably in a passive type of manner, so resting limit buy orders down here. And we have this nice cluster of volume down here, and then the market quickly becomes imbalanced. So what we see here is there are obviously more buyers than there were sellers down here, and more buyers are stepping in, and they want to get long this market, so they start entering the market via market buy orders. And then we get a new bar, and some more volume comes in, and maybe some limit orders are filled there, maybe some stops, maybe some sell market orders. And then once again, we have a overwhelming amount of buyers stepping into the market, taking initiative to lift the price higher. So how does that look on your DOM as far as that goes? Because that's where it really gets interesting, and I think a lot of people, like I said, probably don't quite understand how that works. And I've shared, on my website as well as different venues, my analysis using the volume at price tool. But this is never anything, I've never discussed this part of how the orders are filling in the market, which I feel is a very key element to it. So as we know, the market is a live auction process, and when perceived value is rising, obviously buyers will be continuing to buy at higher and higher prices. It's just common sense there. So when we look at our depth of market again, as in the example I was saying earlier, and consistent with this here, we had passive buyers being filled here, and then as the market was stabilizing and more buyers were stepping in, there became a buying imbalance, and at that point psychology obviously changed, the perception of value changed, and the market's demand started lifting higher and higher. And at that point, right around here, as I'm pointing on this diagram, the only way to really get filled it was via entering the market with a market buy order, and this is just a fast move through this area. So what we have here then, I mean, sure, you could try and wait to get filled via a limit order, but look what's there's a very small amount of contracts being filled here. So you have to enter through in the market via a market buy order. And then what happens here is, okay, so at this current price, so we're going to enter in with a market buy order. And we have 623 contracts trading at the offer. And in our particular scenario, we want to buy 1,500 contracts at 1567, and we'll keep buying them all the way up until 67 and 50. And so right now we know, or we can see, that there's 623 contracts available there. So if we enter in the market, I mean, who knows what's there by the time we enter our order into the market and what's left in the inventory there. But let's just say that, let's just, for round numbers, let's say 23 get taken out before our number or our trade hits the market. So once we get filled, we take out the remaining 600 contracts there, and the bid then, because there's no more inventory here, the bid needs to lift and the offer lifts higher. So we start eating in to this 67 and a quarter level to fill the remaining 900 contracts that we need. So again, the bid is lifted higher, we're taking out this higher inventory, and this is what's happening. This is what we're seeing here. So let's say that in this particular example, the buyer needed to fill, let's just say, 2,000 contracts. So they're hitting the offer, filling. They get filled at 1,815 contracts, and then they just clear out that inventory on that level. So the market needs to trade higher from there, and they get their next 200 contracts filled in there. And then that's just basically what happens. And when you have multiple participants aggressively buying the market, you see these fast moves. And then when they back off, you'll see, limit orders come back in, and then you get that second wave of buying. And it's just a psychological type of thing. So people are panicking that they can't get that price they want, and they just start hitting the offer with market buy orders. So hopefully that makes sense. So all we're doing is we're eating into the inventory that's resting in the market there. Sure, there's sellers trying to hit the bid in these scenarios as well, and we do see some of that coming in here. But when the market becomes really imbalanced, they obviously are backing off, and you see these just real thin prints on the bid. So that's basically what we're seeing there. And this is just another extreme example of market orders coming into the market here. What we have is basically there were orders being filled up here, maybe some on the passive side, and then for whatever reason, sellers started hitting the bid very aggressively. This often occurs when there's maybe some sort of a news announcement or something like that, and basically just liquidity gets pulled from the market, and the market just basically flushes through and clears out whatever inventory was resting there. And then there's usually, when you see that, there's usually, and this is with the ES, so that's a very liquid market. So basically what happens then is some responsive buying will come in and fill in this volume again. So, but this is just an extreme example of orders all coming in at the bid, and that's not, it's just basically just liquidity being pulled, as well as sellers coming down and hitting these resting orders that are in the market, and those could just be people looking to buy that particular level too. So it really, it's just a different way of looking at that. In this example here, what this is basically how you would see a TWAP or VWAP order coming into the market on a major imbalanced type of day. And this is really just I'll provide a zoomed in version of this later, but this is just kind of how you could see it all occurring. And what this blue area here is just the developing value of the day with VWAP in the middle there. And this is the TWAP will look exactly the same, basically, maybe slightly different, but pretty close. But anyway, so what you'll see here is that there's a lot of buying absorption that came in down here, more buying here and here, as well as some buying here. So what you're seeing is at this level, these algorithms were able to execute their buying at, or actually better, and then at VWAP and TWAP. And then the market became completely imbalanced with way more buyers than there were sellers, and every time from that point on the market touched the top of value, immediate buying came in. So there was buying absorption, and then they would get aggressive and lift the offer higher. Every time you come back, buying absorption, lift the offer, buying absorption, lift the offer, and then finally buyers are exhausted up here, and sellers start to finally come back in, and two-way trade returns to the market. But the progression here is, like I said, you're beating VWAP there, and then we're right at VWAP there, and then the market's just completely imbalanced at that point. Delta is very positive, and every time it touches perceived value, whether it's just the top of value, that's how imbalanced the market is. Buyers are immediately stepping in because that's the best execution they can get for that particular scenario. So they're stepping in big time and continuing to buy what's perceived value. And then, like I said, buying exhausts and the market just comes back into balance there. And not to say that these are short trades coming in the market, it's really just liquidation and whatnot coming in. So using the volume at price tool to identify entries. This is, now that we've talked about the different order types, we need to be able to recognize them in real time to understand the order flow and determine whether or not our trade location makes sense. So regarding trade location, I mean, first and foremost, this is just an indicator. This is not a trading method. You shouldn't be deriving trades simply off of what you see occurring on the volume at price indicator. And the reason is simply that there's areas of congestion will make it look like there's something going on there, and it's really just noise. So you just gotta know that and recognize that. And I highly recommend